Wondering how ETFs can fit into your portfolio? Join us for our Spring into ETF Investing event, premiering May 24th and 31st. Check out these two exciting two-part events, which we curated specifically for you, the DIY investor. Our special guest speakers and insightful industry experts will provide you with the information and education you need to confidently manage your own portfolios. You won't want to miss these specials.
Hey everybody, it's Larry Berman here. Well, it's Mother's Day weekend, and it just reminds me of a very special woman who passed away now. It's 2012, so it's been an awful long time. That was an old picture. That was probably 20 years old. But I was just kind of thinking about her today and what I've planned for the mother of my children this weekend, and just like to wish every mother out there, thank you all for the great things you do for your families. Can't say that enough. Markets this week, we learned a couple of interesting things, but the biggest thing to me was the bond supply got taken down relatively well. Given where TLT started the week and finished the week. So that's was a positive. But we saw a slight uptick in the initial claims, and I want to take a dive into the chart room to inspect that a little bit closer. So a couple things on the chart here. The white line is the initial jobless claims that is seasonally adjusted. The blue bars are the non-seasonally adjusted, so the raw data. And so they tend to smooth these things out. Why? Because, after the holiday season, you get a bunch of layoffs. So that typically happens here in early January, and you can see that typically year after year after year. You get some layoffs that happen in the summertime. And that's related to the end of the school year and some teachers maybe not working and so forth. And so you have this seasonal patterns. You tend to get more going back to work, for example, in September, and that's the opposite of this. So they tend to try to smooth out the data. And then even more, because this is a weekly series, they put a 4-week average on it to really smooth it out. So a lot of the economists on the street like to look at the 4-week average. Historically speaking, when we look at the claims data and we look at recessions, so historically that number, when we think about a recession, is pushing towards about 300,000. So if you think about how many jobs, what's the natural rate of job turnover, the JOLT survey is very, very good for that. But when you look at that natural number and say how many people have to start getting laid off before we net start losing jobs every month, historically around 300. And you adjust that for the size of the U.S. economy and the labor force over time, and that number slightly changes, but it's still somewhere around 300,000 weekly, where you would say there's more people getting laid off than there are people, getting jobs. And net, we would see on a monthly basis starting to lose jobs overall. And so we're nowhere near that. And you can see in this 4-week average and the weekly series that while 1 week doesn't make a trend, it's the highest number on a weekly basis that we've seen since, November of last year, but really since May, June, July, where we started to see some weakness come into the markets last year. All will know we started to see weakness in the equity markets around the time when the quarterly refunding, again, the debt size was getting so big, bond yields were going up. And so from a market perspective, we were starting to see weakness in Q3, and then Yellen came in and pivoted. The Fed pivoted from their rate hikes, and we got a risk-on rally late last year and early into this year. So jobs are a big part of the Fed's focus here. And so when we got this softer data, markets kind of ticked up on later in the week. When we think about the economy, again, let's go back and look at 3 years worth of data here like we did with those claims numbers. And when we look at, I like to look at this sort of equal weight retail ETF. That's this white line here. And so on a total return basis, being in retail stocks, so how strong is the economy and what's doing the lifting for earnings and growth? It's not the consumer. And while we're all still full employed, that's not translating into earnings growth and revenue growth. Well, maybe some revenue growth, but earnings growth for the retailers. Again, equal weight basket of retail stocks. So the U.S. economy and the consumer in the U.S. is thought to be the biggest retail block in the world by dollars, and retail stocks, again, equal weight, not doing much at all. And then you look at, well, let's look at the economically sensitive sector, and so small caps. And again, Russell 2000 last 3 years, losses. The broad U.S. stock market, VTI, orange line here, average return last 3 years, 7.69%. When we look at the market cap weight of technology, 15.86. When we look at equal weight technology, RSPT ETF, 8.57. So the message, of course, for the last few years and since the recovery coming off the lows in 2002, everybody ought to know large cap tech has been leading. When we drill down and look at on a year-to-date basis, are we getting the similar story here? And the answer is white line, XRT, equal weight retail, Russell 2000, US market overall, technology, market cap weighted, and then technology equal weight. And so again, still for the most part, which most of the heavy lifting was earlier in the year, technology is still winning. And on average, the economy's not strong here. The consumer, even though fully employed. So it leads me to believe that when the consumer ultimately breaks, the market's got some trouble ahead. And so that's really still a big part of my thinking here and consideration for risk overall. Can the market break out here? Because if you again look at VTI and you look at relative to the highs from a few months ago, the answer is this week, CPI. So CPI and retail sales both come out Wednesday morning at 8:30. That's going to be big, because if we get a combination of data that suggests the inflation has come off and the consumers on the moderate side, then I think we'll see the market at least test a new high. And then the question is, can we sustain and maintain a new high? And if that fails, you're setting up a major double top here. And ultimately, what the vote by investors are is that we're heading in for a weakening consumer and a weakening economy, and that the soft landing scenario is less likely. And so this is going to be a pretty big week for markets from a technical perspective at those new highs and from an economically sensitive sector perspective. But one thing that hasn't changed and isn't going to change for quite a long time is the combination of what we see in this graph. So this red line is the total federal debt outstanding. Great financial crisis, zero interest rate policies, government spending money to save us. And we had this trend that was bad, but not catastrophic, turned into aggressive government spending. But at the time where interest rates kind of went down. And so this blue line is the yield to maturity of the entire basket of outstanding US debt. So what we're doing here is we're taking the global index and we're saying what is the yield to maturity of that basket. Now, as the Fed started to try to normalize prior to when they pivoted in 2019, we started to see the cost of debt going up. The average coupon started to go up. Fed pivoted, and then of course COVID, back to zero rates, and average bond coupon comes down. So now in the last few years, as rates are going up, the coupon is going up, the yield to maturity is going up, but this line isn't improving. In fact, when you look at that line projected out using the Congressional Budget Office forecast, this line is up and up and up. So, as Dennis Gartman used to like to say, up and to the right. And so that's a bull market, but this is a bull market in a horrible fiscal outlook for the US. So we've got a problem here because historically, when you get a recession, the fiscal outlook is worse, right? Like that is something that we can't change at all. Like that is just a reality of the world. So, the higher for longer message here, and when bond yields start to come down, and they come down because we've got a hard landing, how far can they go down before this colossal new debt just keeps putting pressure on yields? And I would submit that we're not going to see that average yield to maturity, short rates, long rates, everything come down below 3%. So, you've got in a few years, 40 trillion of debt to finance at an average coupon of 3.5. And that's just a bad headwind for capital markets, crowding out of the private sector, competition for assets that might otherwise gone into equities. And with the cost of capital going up, it should impact margins. So the average stock is going to be somewhat challenged, but technology companies that have good balance sheets and still a lot of growth might just maintain their multiples. The multiples will come off, don't get me wrong, in a recession, but they're higher valuations. And so, that's the narrative, I think, in front of us here into what risk the market is. We saw the S&P dip below 5,000, and then as soon as you get Fed policy and Treasury saying, no, we're going to make it easier for financing, markets are able to rally again. And so to the extent that they can continue to do that, we'll see. It almost doesn't matter who wins the US election from the perspective of this chart, and that the fiscal outlook is bad no matter who's running things. President Trump, here, like that was Trump, and then this was Trump, and then Biden takes over. But this was COVID, right? So now a lot of this other stuff was, way too much fiscal and caused the inflation. And so I think from that perspective, the Biden government is really a bad spend in that sense. Anyways, I don't want to get too political here, but you know my fiscal conservative stance if you've followed me for any length of time. I'm fist pounding that this matters a lot. Sometimes it matters more than others for markets. But this is a major growth headwind for the world if the largest economy in the world has this bad fiscal outlook. But everybody else has it too. China on through to all of Europe to Japan and so forth. And again, you can't trade this from a stock, perspective. You can't trade this. This is a real big macro thing that we have to understand is a headwind to growth in the world, and ultimately should mean that multiples got to come in and rallies at this point, other than short-lived, probably aren't sustainable. So I would bet this week that even if CPI prints friendly, that the market will try to break out and probably fail. So that's kind of my expectation here. We'll see if I'm right. Anyways, to all the moms out there, have a wonderful weekend with your families. Thanks for all you do for your husbands and children and wives for that matter. Anyways, have a great week, everyone.